Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Andy Cronin. Andy is the CEO of Avolon. He's joining us for the purpose of our Aviation News Report for 2025. And we're recording this in our Dublin studio in late November. Andy, thanks as always for joining us. Before we get into the meat of the conversation, do you want to tell our watchers, all of whom I'm pretty sure will know, but a little bit about Avolon?
Well, thank you, Joe, and great to be here. Avolon is a team of 240 people. We actually did a survey a couple of weeks ago, and we did one of those word clouds. We asked people to describe Avolon in their own words. And the top 4 words that actually came up, I think, summarise it pretty well. They were fun, collaborative, fast-paced, and inclusive. So they're not my words. That's what people in Avolon actually see the company and the culture as. We're also a lessor of scale. We have the largest order book of any of the lessor peer group today, with 442 aircraft on order, coupled with about 600 in the delivered fleet. We are a privately owned business that is rated completely independently from our shareholders, access to investment grade capital, and funded predominantly in the US bond market.
Excellent, Andy. And we might pull at various strands of that as we're going through the conversation. But maybe let's start off on the customer side. Can you talk to us about how you've seen the demand environment evolve over the course of 2024?
The demand has significantly outstripped supply of aircraft. I think that's well documented through the course of the year. We anticipated a lot of those trends. We were the third largest buyer orderer of aircraft in 2023 after Air India and Indigo Airlines. We ordered 200 aircraft in 2023 alone. Those trends have continued to propel the market. We're also seeing that in the pull back into service of older, less efficient, more economically prohibitive aircraft. A340s, A380s are getting pulled into service all around the world, actually, and we see that demand continuing to outstrip supply on the narrow body side right through towards the end of this decade. And on the wide body side, we think it could be even further beyond that.
And as you maybe assess the operational environment for airlines, demand strong, but we've seen maybe some challenges, particularly we look at something like costs of pilots, maybe labour challenges. Your perspectives on, or let me ask it a different way, do you have any concerns looking into 2025 as to how airline performance might evolve?
We think all of the ingredients are there for further modest gains in terms of profitability in the airline sector. We've seen some consolidation. Yes, there's cost pressure. Yes, there are airlines which are failing in small scale and isolated pockets around the world. But overall, you look at the profit margins of the airline industry, we see that continuing to grow into next year, actually. And one of the things that I think airlines are having to navigate, actually, is currency. So while oil has stayed relatively low cost, there's cost pressure on the human side for sure, on the engine side for sure. But we've also seen airlines in different parts of the world get into some difficulty because of a really strong dollar, and airlines that don't have a natural hedge in their own revenues are really struggling with that.
And on the opportunity side, as Avolon is assessing it, is it particularly geographies you're seeing it, or does it kind of parcel out broadly worldwide?
I think what we've seen is parts of South America, parts of Asia. The yen, for example, is at probably a 40-year low against the dollar. We've seen parts of South America really struggle with that strong dollar. And then within North America, we're seeing probably a shift away from some of the low-cost carriers, and the market currently favouring higher margin operators who have loyalty programs, who have other streams of revenue, but are also able to employ quite aggressive pricing models to fill the economy class of the planes.
And then if we move to the supply side, which you quickly referenced at the start, maybe talk to us a little bit, as you say, a very significant order book that you are continuing to grow out, while at the same time we've very evident challenges in relation to both manufacturers and on the engine side. How is the supply side challenges feeding into the business?
We're struggling to get aircraft on time. The manufacturers on both sides have delays, which are resultant from significant upstream supply chain challenges. I think during this year, for example, Airbus cited availability of steel as one of their constraints for their production ramp. But we're seeing pervasive and broad-based supply chain issues, from components like seats, galleys, certification around those, supplies of resin, supplies of raw material actually that feed into the tier 3 suppliers, and that is cascading down through the supply chain. Obviously, there are big steps with Boeing having ended their strike and beginning to ramp back capacity. We've been consistent now for about 3 years in saying that we think that the production ramp from the manufacturers is going to take about a year longer than signaled by the manufacturers. And right now, today, we're still saying that, actually. So although that timeline has effectively moved for 3 years, we still think it's a year further than the manufacturers are forecasting at the moment.
And is that pushing you out then to kind of normalcy really at the end of the decade, or when do you see that coming back?
I think it's very close to the end of the decade before that comes back. And I think that one aspect of that is the tone of the regulator, because that's what's actually creating a lot of bottleneck around certifying new suppliers, around supply of seats into the market. And I think it'll be interesting to see how that relationship with the regulators change as a result of administration changes over the past weeks.
And if you look at the supply side piece as a large lessor, can you give me your thought process around the good and the bad to it? So presumably it's been a positive in relation to maybe keeping some discipline on airlines from a pricing perspective, but you're not getting the assets you expected, but then you own a lot of assets that are presumably ticking up in value. So as you look at it in the round, do you view this as a net positive or a net challenge for Avolon, acknowledging that it's a net negative for the sector?
So I think over the medium term, it's important the market stays balanced, and both lessors and engine manufacturers actually are very aligned in that we want to achieve the economic useful life of the aircraft of 25 years. What's destructive is short-term unexpected delays. And that is damaging to our airline customers and to our business in terms of financial impact. So I think while we almost seek a balanced market over a 10, 20, 30-year time frame, what is difficult and expensive for everyone to manage is the stop-start. And that's really quite damaging, actually, for the industry. And, frankly, less so for our business than for the airline business model. If they've expected an aircraft in May or June in the Northern Hemisphere, they've sold seats for that through the summer. If they're now not getting that until September, they have to either cancel flights at huge expense or find alternative lift at huge expense. There's no good option for those airlines.
And from a communication perspective, how have Avolon found your interaction with the OEMs?
We're obviously a big customer for both OEMs. We get, I would say, the best information that they have at a given time, but that information has been changing. Obviously, the strike with Boeing has been a wild card, frankly, in terms of when that stops, how long it takes to ramp back to production. On the Airbus side, there are a lot of challenges, frankly, with the supply chain around BFE and seats in particular. And actually, we're no longer really looking at our contractual rights for setting specifications in the contract, because the ability to get those seats, the lead time is actually longer than we would have specified in our contracts. Overall, I think in terms of the health of the backlog, because people have talked about manufacturer backlogs now reaching out into the 2030s, which is correct, clearly. But I think that through COVID, the quality of that backlog, you talked about how it moves around different parts of the world and so on. What we've seen is the average credit quality move up in terms of the next 3 or 4 years. Because put simply, airlines that struggled during COVID didn't make PDP payments or deferred deliveries. The manufacturers were very proactive at moving them out in the skyline. And actually what's happened now is, if you look at the credit quality of the narrow body backlog, the wide body backlog, it's as good as it's ever been. So we don't expect really shocks, downside shocks, to the demand side, which could come from a single airline failure or a group of airlines failing. On the converse side of that, there's significant upside potential to demand, which is China international traffic remains at very depressed levels. China-US around 30%, China-India at 0. If those markets come back, that is going to be a fast-moving upward shock to demand for aircraft.
Yeah, it's phenomenal when you think they're the two most populous places in the world and no one's flying between them, right? It almost beggars belief. It's very interesting to see how that piece goes. If we move then maybe on to what you're seeing from a lease rate perspective, like heightened demand environment, interest rates up, corollary is we see lease rates rise. Curious to see the level to which you see them rising. And can you also talk to us about lease extensions? So how is that evolving in a heightened demand, constrained supply environment?
Yeah, broad-based lease rates have increased, certainly on some asset types by 100% since the start of 2022, so a doubling of dollar rents, albeit from a low base. That would have been the more out-of-favour aircraft types, which clearly had fallen to a very low level. Overall, to me, it feels like we're in what I would describe as a base market for lease rates. We're on similar lease rate factors to where we were in this interest rate environment through the last cycle of 2004, 2005, when interest rates were up around this level. So that all feels consistent with the long-term returns that should be inherent to the sector. It feels like there could be more to go, actually, if you look at those supply constraints. And remember that dollar rentals of aircraft are a relatively small portion of an airline's overall cost base. So the impact of that higher rental or higher ownership cost is frankly drowned out by maintenance cost, FX, staff cost, all of those factors which go into creating the incredibly complex organism that is an airline. So I think that trend continues over the course of the next year or so. We're seeing airlines respond to that in two or three different ways, actually. Clearly, a lot of airlines want to extend aircraft that they have. A lot of them have left it too late because there's been demand for those aircraft, and the timeline for placing roll-off has shifted from probably 12 months out to 24 to 30 months out now in terms of real active multiple bidders looking for aircraft. In many ways, the easy thing to do is to extend with the current operator. It minimises cost, friction, etc. But we rigorously market test every aircraft that's coming up for availability and make sure that the existing airlines know what's happening. We're seeing that result in meaningful increase in returns for our business.
Yeah. If we then shift on to the trading environment, Andy, might come to the Castle Lake transaction in a couple of minutes, but more broadly, your perspective on how healthy or the level of increased activity we've seen from a trading perspective.
So in 2023, we sold 31 aircraft. The market was, regaining confidence and pricing levels post-COVID. This year, in the 9 months to September, we disclosed we'd agreed 84 aircraft sales, which is clearly a significant uptick in the volume. The demand for aircraft is strong, coming from multiple factors. One factor is lessors with smaller scale order books or no order books that need volume to grow and deploy capital. That continues to be strong. We're seeing airlines acquire aircraft as they move into the last 1/3 of their life in particular, where they can then take control of having contingency capacity in the event of further manufacturer delays. And we're also seeing an increase in the amount of capital just looking to come into the sector and go to work on specific, whether it's credit or jurisdictional aspects of the sector.
So clearly that's a greater than 50% uptick you've seen year on year. If you had to put a lens on that pre-COVID, are we getting in and around similar trading levels, do you feel?
So over the last 12 years, we've sold about 400 aircraft. So if you adjust for the scale of our business then versus now, look, I think we're probably consistent with a midpoint in the cycle. We're not selling enormous outsized amounts of aircraft, nor are we hanging on to all the aircraft that we could. So I would say it's absolutely right down the middle of the fairway at the moment in terms of the trading volumes on and off the balance sheet.
And then maybe, Andy, if we move to the liability side of the balance sheet and maybe start around with interest rates, and just we had this conversation a year ago, higher for longer, whiplash of 22 into 23 and how the interest rates moved, starting to see some ticks downwards. Your perspectives as a large lessor on how impactful interest rate movements are or aren't to your business? Like presumably you've got that natural hedge in theory between financing and your the lease term that you have, but your perspectives on what the rate environment does from a business planning perspective.
I think the interest rate strategy has been one of the differentiators of lessor strategies actually over the past 5 years, where the impact of that sustained low interest rate environment, where effectively money was free, shaped a lot of behaviour and a lot of speculative investment in the sector actually pre-COVID. Our view has been to prepare the business for higher for longer, but position it so you can take the upside of interest rates coming down. So our overall funding cost hasn't moved overly significantly. Certainly the revenue side has been outpaced in terms of the growth and expansion on the revenue side compared to the interest rate side. But that's not consistent across all of the lessors. So lessors, generally the large scale lessors all hedge their interest rate exposure. One of the differences is the duration of that hedging and how long can people withstand that higher interest rate environment, or are people consciously taking a view of we're going to bridge this to a shorter, lower interest rate environment. We've been busily preparing the business for higher for longer, which I think has served us well over the past 12 months. And certainly with the kind of volatility that we're seeing now, in recent weeks, we've had the 5-year Treasury up at 440, down to 350, back up to 420. That's a massive movement. If you think about the spread for an investment grade lessor, our spread is now 90 to 100 basis points type range, but you're seeing a 70 basis point move in treasuries, and the absolute level of treasuries 4 times or more the level of our spread. So this is about how lessors are managing treasuries now rather than their spreads.
And how has that spread evolved in recent times?
I'd say 2 years ago, that's come down from about 300 basis points down to 100 basis points. And that's probably an average of the investment grade lessors. We're seeing very, very strong market access. We've been talking about, including with yourself, around how underrated the sector was and how performance through COVID has actually solidified the rating agency views that these businesses should be rated more highly than they were. And we've seen a suite of upgrades, our own ratings. We have 2 on positive outlook for further upgrade. We think that trend continues given the level of stress that was applied to the business models. And Avolon's story through COVID is completely organic. So we had no material or significant M&A or no M&A during those years. We had no shareholder support, no equity injection. We went into COVID in 2019, came out of it the other side, and all of our key metrics, our gearing ratio, liquidity, all our spread metrics are all better than they were before we went into COVID. And that's the story of an organic business getting through the biggest crisis the industry had ever seen.
Yeah, and it feeds into that point, right? You have a COVID impact, you have a Russian-Ukraine war impact, but the resilience trumps it, and the returns from either profit perspective or, more importantly, a cash flow perspective are really, really strong. How has that fed in, if you look broadly then at the debt products you guys have availed of? So obviously, large investment grade, positive outlook, as you mentioned, ability to tap that market, and then you've also been active around kind of term loans as well. Can you talk to us around the debt products you've been utilising over the last year or so?
So predominantly in the US capital markets, that's where the deep pockets of scale are. We like having some term loan in the mix because it actually gives us an opportunity to redeem and return debt capital at very low cost. So it gives us flexibility. That tends to be a floating rate instrument, but we generally hedge it using swaps and so on. And then the largest form of funding for us is the US unsecured bond market, which remains the cornerstone foundation of our capital structure. That's the one that clearly has the deepest access. There's about $150 billion of lessor unsecured bonds in circulation today. Compare that to, say, EETCs, where it's $30 billion, or the ABS market is in the teens of billions of dollars. So we've also, in the past years, seen a migration away from the traditional secured bank market, largely driven by regulatory change, where banks struggle with the asset class in terms of the treatment for regulatory capital, but also the duration of 12 and 15-year financing. And a lot more of the bank market is moving into addressing their aviation exposure by putting traditional unsecured corporate loans into key borrowers. For us, we've seen quite a large diversification of that bank base over the past 18 months. We did our first deal exclusively in Middle East and Asia. We did our first deals in India in the bank market there. And we've seen a number of lessors go to other jurisdictions to actually raise unsecured bank capital quite cost effectively over the past 12, 18 months.
To pick it in, that's really interesting stuff. To pick maybe 2 points, I'm going to go back to the bond market in a moment. That would seem to imply, as you say, maybe Asian capital or other capital on the bank side, and a shift away from maybe the European banking network, to your point, where the regulatory piece is probably biting even harder. Is that fair?
That's fair, and I think also the Asian banking market has generally been focused on the higher investment grade levels. So as the industry moves into that category, it opens up access to that pool of capital.
And on the unsecured piece, I'm not going to say it's been easier, right? But as more debt capital is raised by investment grade lessors, does it become an easier egg to crack, if I phrase it that way, because there are more investors getting more familiar with the business model?
I think the liquidity definitely helps. However, as you move further up the ratings curve, it becomes more of a sector bet by investors and more of an index bet. So I think as there's more and more indexed bonds in the market, you see large volumes of funds move in. The sort of highly specialized, highly knowledgeable investor tends to be more focused in the high yield, where they have to actually do, frankly, more work to understand the relative performance and outperformance potential. There's some of that in the investment grade space for sure, but a large portion of the investment grade space is looking at the ratings as the primary pricing tool.
Yeah, and maybe one point you touched on there is the ABS market, one that sometimes I think we spend a little too much time talking about given the size of it, but an area you guys have played in the past. But typically when there's been an E-note market, so clearly ABS as a debt tool is not going to be attractive to you guys, where you can go and issue bonds. But how important do you think that ABS environment is for the aviation finance sector more broadly? And to the extent the E-note market was to come back, is it something you could see Avolon using again as a kind of asset manager play?
Yeah, so we've done numerous ABSs with E-notes. I think the ABS market is important and useful. It's probably important for professional services fees, frankly, because they are quite...
It's a very good product, Andy. It's a very good product.
They are quite expensive to put in place. Okay, so they are quite cumbersome, and it tends to be a little bit of you have to sink all the money and time into it and allocate aircraft to it for quite a long lead-in time before you actually know if your deal's going to get away or not. There's no doubt that having an active E-note market is a significant step forward in terms of the relevance of the ABS market for any of the investment grade lessors. I think most of them have done E-note ABSs over the previous cycle. I think that the scale of that market always tends to be relatively small. And I think whereas last cycle we had a number of lessor platforms where really their purpose was to bridge warehousing aircraft specifically into an ABS E-note exit, I think we're unlikely to see that happen in the same scale. I think this will be large-scale lessors peeling off portfolios here and there and possibly having to take greater ownership in the E-note themselves to align interests with the investors that are coming into it.
Yeah, and maybe if we keep with that investor theme, Andy, any interesting trends you've seen or noticed on the nature of investors coming to the space, be that on either the debt or the equity side?
Let's do the equity side first. Clearly, there's two US publics. Outside of that, when you look across the field of the top 15, 20 lessors, you've got one Middle Eastern and the rest are Japanese or Chinese. I think the Japanese scale of incremental investment, we've yet to see how that unfolds post the currency movement, which has been very, very significant for Japan over the past, I would say, 3 years. But it's very long-term patient capital, and Japan has a multi-decade history of an active aircraft trading and knowledge of the sector and the industry. The Chinese side then, again, we haven't seen new investment come into the sector from the Chinese players, but we've seen Bank of China, CDB, etc., continue to be very active, order aircraft, grow their businesses. So I think it's really interesting to see how that plays out in terms of looking at the larger players in the industry and where does the next big capital come from. Obviously, we've seen Aviation with PIF, with large-scale ambition and deeply rooted objectives and scale in terms of the capital that they can deploy. And it will be interesting to see if there's more, for example, coming in from the Middle East or other parts of Asia over the next 5, 10, 15 years.
And maybe we pick up on that scale piece around the macro leasing environment, as one of the largest lessors in the world and one of, population of 10 or so, maybe investment grade, maybe even slightly less lessors. Some of the conversations we're having as part of these series are around, well, will we actually end up with maybe 5 supersized lessors where OEM order books contract into a smaller number, cost of funds becomes really, really important, and therefore it just starts to shrink as to who can play in sale and leaseback, who can get delivery of those aircraft. Would you agree with that theory, or do you think we still end up in a situation where we've 10 or 12 who are still of reasonable size?
I think there's significant advantage to scale, and I think we're seeing consolidation come through in multiple ways, actually. I think one is the order books. So if you look pre-COVID, there were 11 lessors that had order books of over 100 aircraft. Today, that number is approaching half of that. So just the limited access to order book. A new entrant, if they want to order aircraft, it's 2032. So that suggests there won't be further fragmentation. It's the big, patient, strategic guys who can actually wait to get delivery of the aircraft for 3, 4, 5 years, not a new investment proposition. So the order books are going to drive a reshaping of the industry, even just based on what's there today. And then we're also seeing consolidation. AerCap, SMBC, ourselves, we're all effectively accumulations of 4 or 5 businesses, platforms, large-scale portfolio acquisitions, etc. So that trend is continuing. We're actually seeing quite a large level of consolidation across the big players in the industry.
And maybe that's the opportunity to talk to us a little bit about the Castlelake acquisition. So congratulations on that transaction. Can you talk to us, maybe tell us a little bit about the transaction, its strategic importance or value to Avolon, and then the add-on to that is there more of that out there? Is there ways for Avolon to tag on $4 or $5 billion of assets at a time?
So the Castlelake transaction is exactly that. It's tagging on a portfolio of $4 to $5 billion, where that portfolio was accumulated and acquired by Castlelake by a team we regard well during the years just prior and predominantly in COVID. We saw attractive terms and conditions and good quality in that portfolio. It's accretive to all of our broad-based metrics, whether it's the amount of new technology, the average age, the average lease remaining. It fits very well with our existing portfolio, overlaps well with our customer base, doesn't give us large concentrations, but there's only 2 or 3 new customers in that we didn't already know. So it's a very easy transaction from that perspective. What made it possible for us was having the balance sheet capacity and liquidity to move quickly and provide certainty to Castlelake as they began reshaping their own aviation business to take account of what they saw in the future.
And are there more of those opportunities out there, do you think?
It's a very, very finite list. I think the amount of opportunities in the $1 to $2 billion is far greater than in the $4 to $5 billion. And then as you go above that, the number drops off dramatically in terms of not just portfolios that might be of interest and have the scale and so on and quality to be attractive, but a shareholder that's willing to sell. And that's one of the features of this industry. The great thing is these businesses are so stable. Some of the downside is these businesses are so stable.
Yeah. So finding, I think you're right. I guess we look at it's really being a strategic seller or a distressed seller, and not evident at the moment who that population might be. Just shifting gears slightly, Andy, an area we've talked about, and we would have talked about a year ago, is around environmental concerns and challenges. Myself and Victoria, when we were putting together this question, has probably debated on whether we kept this in, right? Because if we ask people, is it impacting on your ability to, attract equity or price your debt? Generally, be no. I don't answer the question for you, but that's what we hear back. And then it will, but we don't know when. Like, are environmental concerns impacting on the Avolon business?
They certainly impact our business. So we've been clear in terms of our own sustainability objectives. So we've committed to having 75% of our fleet migrated into new technology by the end of 2025. That's a near-term and concrete commitment, which we remain focused on delivering. It's not easy because new technology aircraft haven't been delivered at the rate that we expected. But I think we need to recognize the important role that lessors are playing, because a lot of people are talking about what transition will we do in 5, 10, 15 years. We're still finishing the transition now. So every single 737 NG or Classic that's operating is burning 20% more fuel or 15% more fuel than the latest version of that product. And what lessors as a collective are doing is financing the vast bulk of that transition, actually, and certainly through COVID, stepped up to keep that production line going. So I think that's important context. So does it shape our business? Yes, it shapes our portfolio strategy and shapes our approach to dealing with our sustainability commitments. Other things we've done, we invested in Vertical Aerospace, the eVTOL manufacturer, which is currently test flying aircraft number 2, well on its path to certification at this point. We also partnered with Airbus during 2024 on Zero E, which is a program where the objective is to have a hydrogen-powered commercial flight in operation by 2035, which is, I think, a much more audacious and bold ambition than a lot of people would have expected in terms of timeline. So there are the things that we're doing. Is it impacting our funding cost? No. And I think that's the real answer that you'll get from a lot of lessors.
Yeah, and it'll be an interesting one to watch, and particularly as you see the political developments in the US, just what happens in terms of that agenda in the near term. Andy, really great insights as always. Just in closing, and I generally like to ask this one in closing, as we look out into 2025, what are your optimism levels like?
I think the industry is well set for continued recovery. I think the aircraft leasing industry, profit margins are still down a bit, actually, from pre-COVID, and we all have a bit of work to do to get those profit margins back up. But across the board, we're looking at, green light in terms of access to capital. We've talked about how tight our spreads are. We've talked about treasuries. I'm much more comfortable underwriting business in a current, mid-interest rate environment than at the super lows or the super highs. The airline health around the world, the airline sector is profitable. Demand for aircraft is strong. And we have a manufacturer arrangement where I think the supply chain issues will improve modestly during the course of the year, but there's a better handle on what they look like now. So in terms of, I'm not naturally an optimist, but I'm pretty optimistic about 25.
Well, on that hopeful note, I'd like to wish you and the fun, fast-paced, collaborative Avolon inclusive, a very successful 2025. Thanks for coming in, Andy.
Fantastic. Thanks, Joe.